on Skype is Marc Faber, editor and publisher of the Gloom, Boom, Doom report. He's talking to us from North Thailand. Thanks very much for joining us, Marc.
My pleasure.
It's the first day of September. August was the worst month, I think, for 3 years on the New York markets, or rather the US markets, S&P, Dow, etc. Is this a surprise? Is this the start of something, or just a little blip in a bull market?
Well, that's a good question, because the market became oversold, but we also have to consider that essentially the global growth since 2000 was driven largely by the Chinese economy, because as the Chinese economy, and in particular its industrial production, was rising, it created incremental demand for raw materials, industrial commodities. So industrial commodity prices went up very strongly until 2008, and agricultural in some cases until 2011, 2012, as well as precious metals. But over the last 12 to 18 months, there has been a very sharp deceleration of Chinese economic growth. And I think objectively, without listening to government published statistics, which are all manipulated all over the world, including South Africa, without listening to these statistics, realistically growth in China at the present time is maximum, but I say maximum, between 2 and 4%. We have some indicators that would suggest actually a contraction. And so what this leads to is this decline in commodity prices we have experienced. And when commodity prices go down, then obviously the resource producers in Latin America, Africa, Central Asia, Russia, Middle East, and Australasia, they have less income, and then they have less money to spend. And Chinese exports, as well as, by the way, South Korean exports to commodity producers, are larger than to the US or to Europe. And so it affects China itself. And so the Chinese economy goes down even further. And all this then adds to a very gloomy economic outlook, not the kind of recovery all the super bullish fund managers, strategists and analysts and media people expected. And that puts then pressure on equity prices.
Marc, what you're suggesting to me, given what you've just said over the last minute, is that the Chinese factor is the biggest factor. And if that is the case, then we've got it wrong for the last 12 months or so, because when the oil price fell from 115 in June 2014, we should have known that there was something going on. So equity traders have been behind the curve. Other people are saying that the real signal for the current downturn is the US Federal Reserve, suggesting Mr. Fisher, the deputy chairman, saying over the weekend that rates could go up. So there's two different camps, China and the US. Which one are you in?
Well, basically, don't ask fund managers and brokers about the market, because they have a vested interest that stocks and asset prices go up, because they receive their fees from asset prices. In other words, the higher the asset prices go, the more fees they get, and so they're always optimistic. The fact is simply that the Chinese slowdown has been visible for a long time, but a lot of people ignored it. Number two, the fact is the US market is very expensive. And the market in the US, by the time it started to decline in August in earnest, was already down 2% year to date, and compared to a year ago, it was no higher than a year ago. So during that period of time, a lot of stocks went down, but the indices, because the nature of indices and ETFs and index funds are such that a few stocks can drive up the market and that the index no longer represents the true picture of what is happening in the economy and in the financial market. And so we had this break. In my opinion, this is globally a serious break. And the central
Yeah.
banks, in my view, will probably react with more QE, except it may not help as little as QE has helped the real economy since 2009.
We've been going up for 6.5 years. The S&P 500 bottomed in March 2009. Mark, you and I have been in the
Correct.
markets long enough in different ways. I was on a desk on October the 19th, 1987, when the Dow Jones fell 22%. The market is completely different these days, and I don't think we'll ever see a 22% fall in one day. But I've got a feeling about this market that it's
I wouldn't
quite
bet
nasty.
on that. I wouldn't bet on that. We may see market closures in futures. I'm not predicting a market closure or a collapse of 22% in one day, but it could happen because I've just written about this in 87. The leverage in the system, as you should know, was much, much lower than it is today. Government debt as a percent of GDP was much lower. Household debt was much lower. Corporate debt was much lower. We live today in a completely over-leveraged system that is very dangerous.
I spoke to a person on Wall Street around about 2 hours ago on my radio show, Mark, and he said this is going to be a short and severe market. So I've coined the phrase now, a short and severe bear market. So I've called it the Napoleon market. He was short and he was very severe. Do you think it will be a Napoleon market, or will it be more elongated?
My sense is that foreign central banks will follow the People's Bank of China and will try to support markets. They'll buy stocks and so forth, and so they can rebound. I don't think we'll see a new high, but they can rebound and they can delay the process of downside adjustment. But in my view, a lot of people are waking up to the fact that the global economy is not accelerating on the upside, but decelerating on the downside, which will have implications on corporate profits.
Is it your contention that we've had it too good for too long and people have become sanguine? There are people on desks for the last 4 or 5 years that don't know what a rising interest rate market is and don't know what a bear market is. It's been buy the dips. Do you think now we go into a phase where we must sell the rallies, or even worse?
Yes, I agree with you. I think we may have moved into an environment where selling the rallies may be opportune. And don't forget, when the market started to rally in March 2009, as you pointed out, S&P 666, the driver for the global economy, for the recovery, was largely China. A huge credit expansion in China, huge fiscal deficits, as well as in other countries where government debt has continued to expand. Now, I don't think that the Chinese economy can avoid a serious downturn. That, even with money printing, then the currency collapses. And so my sense is that this time the situation is actually very serious, because it's very difficult to see from where the stimulation of the global economy could come from. Plus, we have geopolitical problems. Plus, we have immigration problems. Plus, we have unfunded liability problems. So it's very difficult to see how global growth would be very strong. And in the meantime, you can look anywhere, with very few exceptions. Say the gold mining sector is inexpensive, but otherwise, stocks, particularly in the US, are not particularly cheap. They are expensive.
Just a quick one. I know you've got to go somewhere else. How do we play this now? We can't buy puts, we can't sell calls, because, well, I suppose we could sell calls, couldn't we, because the volatility is so high. How do we take advantage of what you think is going to happen?
Well, my sense is you and I, and if people and investors and fund managers are honest, which is very debatable, but let's assume we are honest, then we really have to admit we don't know how the world will look like in 5 years' time. In absence of knowing how it looks like, we need to diversify. We need to diversify in equities, in bonds, in cash, in precious metals and real estate, and also diversify geographically.
Mark, thanks so much for your time this evening. South African time anyway. That's Marc Faber, the editor and publisher of the Gloom, Boom, Doom Report. And just Google that and you can follow this man's work.